Hey everyone, welcome back to Corporate Decoder, the place where we unravel the mysteries of corporate filings, and tonight we are diving deep into Landstar System, Incorporated's latest quarterly report, which has some eye-opening numbers that tell a very interesting story about the current state of logistics and transportation. Before we get into the juicy details, if you find value in our straightforward analysis of these complex documents, make sure you are subscribed and ding that notification bell. We also have a thriving Discord community where we discuss these filings and more linked right down below, so be sure to join us there. Alright, let us talk about Landstar System Incorporated and what their recent quarterly report for the period ending the 27th of September 2025 reveals about their business. This report gives us a snapshot of their financial health and operational performance over the last 3 months and the first 9 months of the year. First off, looking at the big picture, their total assets stand at approximately $1.66 billion as of the 27th of September 2025. This is a slight decrease from the end of last year when it was around $1.81 billion. Now that might sound like a concern, but let us dig a bit deeper. The most notable change here is the assets, and specifically liabilities held for sale. This suggests they are in the process of selling off certain parts of their business, which often means they are streamlining operations or focusing on core areas. Now for the main event, the financials themselves. Their revenue for the 39 weeks ended the 27th of September 2025 was a little over $3.5 billion. This is just a touch lower than the same period last year. On a shorter 13-week basis, revenue was just over $1.2 billion, a slight dip as well. This tells us that while they are still bringing in a massive amount of money, the overall revenue generation has plateaued or slightly declined. When we look at their costs, the big chunk is always the purchase transportation, which is essentially what they pay to third-party carriers to move freight. This cost was around $2.77 billion for the 9-month period, which is right in line with last year. However, as a percentage of revenue, it is slightly higher this year. This indicates that while overall revenue is flat or down, the cost of getting that transportation done is taking up a slightly bigger piece of the pie. Something that caught my eye is the significant increase in insurance and claims costs. For the 9-month period, this jumped to over $103 million compared to about $83 million last year. That is a roughly 23% increase. This is a pretty substantial jump, and given the nature of the transportation business, accidents and claims are a constant reality, but this sharp rise suggests either more frequent or more severe incidents, or perhaps higher insurance premiums, which is a growing concern in the industry. Then we have this big number impairment of intangible and other assets, which clocked in at over $30 million for the 9-month period. This is a non-cash charge, meaning they did not actually spend $30 million, but they are writing down the value of certain assets. The report mentions this relates to a strategic review of their transportation management systems and an investment in a startup called Cavnew. Essentially, they are acknowledging that some of their past investments or strategies are not panning out as expected. It is a tough pill to swallow, but it is good they are recognizing it and adjusting their books. Despite these cost increases and asset write-downs, Landstar managed to post a net income of about $91 million for the 9-month period. This is down significantly from nearly $150 million last year. On a per-share basis, this translates to earnings of $2.61 versus $4.21 last year. So financially, it is a tougher period, but they are still profitable, which is key. Let us look at a metric that Landstar itself seems to highlight: operating income as a percentage of variable contribution. For the 9-month period, this figure dropped from 37.1% last year to 24.3% this year. This is a pretty steep decline, and it is largely due to that impairment charge we just talked about, plus increased insurance and claims costs. It shows that while they are earning revenue, the portion left over after covering essential operational costs has shrunk considerably, which is not ideal. Looking at revenue per load for van equipment, it was $20.82 in the 9-month period this year compared to $20.85 last year. Truckload revenue is pretty stable then, but if we look at unsided or platform equipment, which is often used for heavier or specialized loads, revenue per load went up from $3,016 to $3,051. This might indicate a shift towards more specialized and higher paying freight, which is a smart move in a challenging market. Now for capacity, they are reporting about 75,000 available truck capacity providers. This is down from about 79,000 last year. Fewer trucks available means potentially tighter capacity and higher costs for getting freight moved. This is a trend we often see when the economy is a bit uncertain. Landstar is still paying dividends. They paid $1.16 per S-hair this 9-month period compared to $1.02 last year. That shows they are committed to returning value to shareholders even in a slightly more challenging financial quarter. Remember those assets held for sale we talked about at the beginning? They total about $13.8 million. This is part of their efforts to divest their Mexican subsidiary Landstar Metro. This move is intended to let them focus more on their core North American operations. Overall analysis. So what is the overall picture here? Landstar is navigating a tough market. Revenue is flat or slightly down, and costs, especially insurance and claims, are on the rise. They have also had to take significant write-downs on some of their assets and earlier investments. This has led to a noticeable drop in net income and a reduced operating margin. However, they are still profitable, they continue to pay dividends, and they are actively managing their capacity and looking to move towards higher value freight. The increased insurance costs and the larger number of impairments are definite red flags that investors will want to watch closely. It suggests that while they are being proactive in addressing issues, they are also facing significant headwinds in the market and in their operational risks. The company is trying to be leaner and more focused. The key will be whether they can turn these efficiency efforts into renewed profit growth in the coming quarters. Alright, that is our deep dive into Landstar System Incorporated S latest filing. What do you think about these results and where the company is headed? Let me know your thoughts in the comments below. If you found this analysis helpful, please hit that like button and subscribe for more corporate breakdowns. And again, don't forget to join our Discord community linked in the description for more discussions and insights. Thanks for watching, and we will see you on the next one.